Good morning, everyone. I want to break my talk in three parts today. I want to give my views on gold and commodities. I want to talk about what not to do when investing in the mining sector. I'm going to highlight major mistakes a lot of investors, a predominant section of investors make when investing in the mining sector. And then I want to talk about the opportunities that, in my view, exist in investing in the junior mining sector. Let me start with talking about my views on gold price. I continue to be very optimistic about the future of gold, and there are three reasons behind it. One is that it is becoming extremely difficult and increasingly difficult to find positive yielding asset classes in the Western countries. In fact, you increasingly find negative yielding asset classes on risk-adjusted basis in the West. But much more important than the issues to do with the Western society are the huge and horrendous problems of the third world. The third world has been given a misnomer, emerging markets, in the last 3 decades. But the third world was the third world, and it will continue to be the third world. The third world benefited from the free gift of the Western technology over the last 3 decades. But these countries are starting to now stagnate across the board. And as they stagnate, their social and political problems will continue to surface. Venezuela and Egypt are not just isolated cases. They are a part of what is happening in the third world. When the problems of the third world emerge, people with wealth in those countries will be looking for protecting what they have, and gold will be a very important way for them to protect their wealth. But there is actually one emerging market, the only emerging market that I know of, and that is China. These people have become increasingly rich over the last 3 decades. And this country was a closed country 3 decades back. For the first time, these people are internationalizing themselves and they are diversifying themselves. And as a part of that strategy, they will continue to invest in gold. I continue to be very optimistic about the price of commodities and the demand for commodities, and particularly the demand for commodities, because of this one emerging market, which is China. Now, this is only one country, but it today consumes about half of all the commodities produced on this planet. China, in my view, will continue to grow in the foreseeable future, and it will continue to underpin the demand for commodities and the price of commodities going forward. Now, here's the problem. When people feel bullish about gold and commodities, they immediately conclude that they should also be bullish about the mining sector, and that's an extremely erroneous conclusion. What a lot of and a predominant part of investors do is that they invest in ETFs, mining company ETFs, or they apply some rules of thumb to invest in the mining sector. And that is a guaranteed way to lose your money. Let me explain this using this slide. Gold has done quite well over the last 10 years. This is the performance of gold in the last 10 years. It has gone up 75%. And gold has actually gone up about 400 to 500% in the last 15 years. Gold has done quite well. Now, when people invest in gold mining companies, their expectation is that if gold went up by 75%, share prices of mining companies, gold mining companies, would go up by a multiple. And the common term used in the mining industry is the leverage that the mining industry offer. So their expectation in this 10 years would have been for the gold mining companies to have gone up by 200 or 300% in these 10 years. Let's look at what happened to gold mining companies in these 10 years. This is GDX, the performance of GDX, which is ETF portfolio of gold mining companies. So quite contrary to expectations of predominant section of investors in the mining industry, instead of gold mining companies outperforming gold, it actually fell more than 50% in the last 10 years. Leverage does not exist in the mining sector as a group of companies. Now, when people invest in junior development stage companies, their expectation of leverage is even higher. They would have expected the junior development companies to not only go up by 200-300%, they would have expected those companies to have done much better than that. Let's look at what GDXJ did in the last 10 years. Its performance has been quite bad, worse than that of GDX. Again, leverage turned out to be anti-leverage. And then when people invest in very early stage exploration and generative companies, their expectation is almost an exponential performance to gold price. What happened to Canadian Venture Exchange in these 10 years? The performance has been horrendous. Let's glean out a few principles from the last slide. Mining sector is a net wealth destructive sector. It destroys wealth. In the last 10 years, gold price went up, but all sectors of the mining industry indices actually went down, quite significantly actually. And particularly the junior mining industry specializes in destroying wealth. What is important is to actually do a thorough analysis of these companies before you invest. If you have no time to allocate to proper analysis, you should stay away from investing in the mining industry because it will destroy your wealth. If you must invest, in that case, you must just buy metals, not mining companies. So let's dissect the graph that I showed you. Why does this leverage not work? What goes wrong? I can come up with 3 issues here. One is that when metal prices go up, the expectation is that profitability of these mining companies would increase. The reality is that when metal prices go up, the costs of making those metal prices actually go up faster, and that actually ends up squeezing the profit. There's another problem. Financial disciplines start suffering hugely in the mining industry in a bullish environment. When metal prices are doing well, managements start paying themselves higher salaries, their lifestyle goes up, the end result is the profit gets squeezed. But most importantly, why mining sector significantly underperforms the metal metals is rules of thumb that investors apply when investing in the mining sector. They promote destruction of wealth in the mining sector. Let me mention some of those rules of thumb that investors apply when investing in the mining sector. I'm not even going to write in my slide the feeling, the hunches they have when they invest. So many people, including institutional investors, just invest based on their hunches. You cannot really do that. You have to do an objective analysis of these companies. But let's look at some of the rules of thumb, the seemingly objective rules of thumb that people apply. One is ounces in the ground methodology. And this is so common in the mining sector, which is one of the biggest reasons, in my view, for destruction of wealth in this sector. What investors do when applying this methodology is that they look at the total ounces in the ground a company has and multiply those ounces in the ground by a certain dollar figure, $50 or $100 per ounce of gold in the ground. And that is, in their view, the value of that company. An extremely erroneous way to put a value on a company. More recently, people have been emphasizing grade. And that is another rule of thumb that has destroyed wealth of investors. There's always an excitement about certain areas, certain jurisdictions when it comes to mining. Right now, there's a gold rush happening in the Pilbara area of Australia. A company called Novo Resources found some gold nuggets, and a staking rush started happening in Australia. Now, in my view, Novo went up for the right reasons, but now tens of companies are staking ground all around that area, and their share prices are going up 100%, 200, 300, 500% in the last few weeks. One more thing that I come across all the time, a lot of investors attribute almost godlike magic to certain managements. Now, quality of management is very important, but you cannot expect them to do the impossible. So, how should you analyze a company? In my view, the only way to put a value on a company is by attempting a discounted cash flow analysis on these companies. Your approach should be a discounted cash flow approach. Whether it's a very small company or it's a big company, I cannot think of any other way to put a value on these companies. As soon as possible, you should try to understand the nature of the ore body, the metallurgy that the rock will face, the likely process you will need to employ to produce and extract the metals, and hence revenue and costs associated with these projects, and as a result, the discounted cash flow on these projects. It's extremely important to understand the quality of management. A bad management will destroy value of your projects. So I stay away from bad management. And I thoroughly enjoy spending time in the jurisdiction that I'm investing in. I was in Serbia 2 weeks back. Most people fly in and fly out. I almost never do that. I always spend a few days extra. I spent a week extra in Belgrade trying to understand the economy, how those people think. In our politically correct environment, For most people, Congo and Canada are the same countries. No, they aren't. You have to understand the local culture, local politics, and local social environment. So let's now talk about the opportunities that exist for investors in the junior mining companies. Most of the value that I come across when looking at junior mining companies is when there is a differential between value and price of these companies. When the value is significantly higher than the price you pay to buy those companies. I'm going to look at this issue from different angles, and I want to mention a couple of cases to talk about it. I mentioned this company, Novo Resources, a while back. During April and May, this company is starting to find gold nuggets at their project in Pilbara. The market did not care about this company. The company was trying to raise money at 66 cents with a free warrant, 66 cents with a free warrant, and they were struggling to raise money while they were already finding gold nuggets. It took the market about 2 months to even start registering that the company had found gold nuggets, and it took the market a very long time to appreciate that the company was finding something. Junior mining industry is extremely illiquid, and there is a very limited following of these companies, which means that there's often a huge difference between value and price, and it takes the market a very, very long time to appreciate the value of these companies. Let's look at the same thing from another angle. This photograph tells you a lot. This is probably the freest economy in the world, the USA. And on two sides of the same road are petrol stations, gas stations. And this is likely the most liquid commodity on the planet. There's a difference of 13% between the gas prices here, 13%. Now, if 13% difference in between prices of the most liquid commodity can exist, you can imagine the differential between value and price that can exist in what is an extremely illiquid sector of the market, the junior mining sector. Let me explain this a bit more using a case study. This is a company called, this does not exist, the company does not exist. Sunridge Gold came out with a news release on the 6th of November 2015 saying that it had signed a deal to sell the company, which meant that every share of Sunridge Gold would get converted into 38 cents when the deal would be closed. Very simple math. I mean, you don't really have to know much more math than 38 cents. Can you imagine what price the market opened at after the news was released? Can anyone make a guess? That day, after the news was released, the share price averaged around 24 cents. There was a 58% upside. You did not need to know more than not even primary school math to see this upside. 38% upside that day. Again, the principle is that because this is a very illiquid market and because there's a very limited following, this exists all the time in the junior mining sector, even when there's an obvious 38-cent price value attached to this share. It was trading at 24 cents. Now, most people, and 12 years back when I started working in the business, I thought it would take a few hours or maybe at best a few days for this arbitrage to go away. Can anyone imagine how many days it took for this arbitrage to disappear? Look at this. Nothing had changed. 40 days later, there was still a 52% arbitrage upside in owning Sunrich Gold. You could have accumulated a huge number of shares in this company during this time. After 3 months, a full 3 months actually, there was still about 38% arbitrage upside left in Sunrich Gold. The principle again is there's extremely limited following in these companies, and anyone who does basic math and who is prepared to do basic analysis on these companies puts himself in an extremely advantageous position. Let's talk about what you can do to exploit this market as an insider to this company. What I talked about earlier was how you can benefit as an investor and as an outsider in this sector. These companies are very small companies. The junior mining companies have market capitalization of sometimes less than $1 million. These companies often have a huge problem raising money from the market. When the company finds difficult to raise money from the market, and when investors realize that, it gets into a vicious cycle. What happens is that investors know that the company has to raise money, so they start selling their shares, hoping to participate in the private placement at a lower price with a free warrant. That's the mentality of investors. But that puts in motion a vicious cycle for these companies. The price keeps falling. What an investor can do is to provide a chunk of capital to these companies if they see value in these companies, and help these companies come out of that value trap, that vicious cycle, and almost immediately book a paper profit by investing in these companies. Also, these companies are very small companies. They don't necessarily have the skills, the cultural or financial skills in the market that they operate. As an outsider, as an insider, you can actually offer them that help as a venture capitalist. I predominantly focus on Canadian markets, and this is the kind of information sources that I look at. From these documents, I get to know the salaries the managements are paying themselves, how much of their own shares they own and trade. I love looking at blogs on these companies, because what is very important for me is unknown unknowns. What I did not think about these companies. In these blogs, there's a lot of emotional chatter, but always I find something that someone might have blogged which makes sense to me and opens up new ways of thinking about that company for me. I go on site visits. I like to know who my competitors are in terms of investing, and I absolutely love learning about the local culture, local politics, and local economy. So, in conclusion, I continue to be very optimistic about gold and commodities. A lot of investors in the mining space probably think gold and commodities haven't done well. Gold and commodities have done extraordinarily well in the last 15 years. It's just that people in the mining industry has lost a huge amount of money, that they end up thinking that commodities and metals haven't really done well. They have done very well. I continue to be very optimistic. But it's important to remember that bullishness about metals should not translate into bullishness about mining. You cannot hope to make money by investing, or at least hope to outperform the metal prices by investing in mining space using rules of thumb. An analysis of these companies is extremely important, and mostly it comes down to some simple math like what I showed about Sunridge Gold. Most investors fail to do very simple math in this industry. There's indeed massive amount of upside for those people who are prepared to give a few hours of their time analyzing these companies. Ladies and gentlemen, thank you very much for your time.